Hello, welcome back. Time now for business news. For that, I'm joined on set by Matthew Warren. Hello there, Matt.
Hi, Louise.
Now then, this news about Berlusconi launching a comeback bid in Italy. That's dominating your news.
Yes, we've been keeping a close eye on the markets this morning on that. One political analyst saying that these problems in Italy could lead to a Greek-style instability. They'll be hoping that's not true. But of course, this all following Mario Monti saying that he's going to resign earlier than elections had been expected. Well, some believe that a period of relative stability for Italy could now be under threat.
Since he was appointed Prime Minister a year ago, Mario Monti has steadied the Italian ship somewhat. The country's 10-year bond yield has gradually dropped, a sign that investors' confidence has been rising. But Monti's surprise announcement that he'll step aside after introducing the next budget, and the news that former Prime Minister Silvio Berlusconi wants to make a comeback, has led to a sudden spike in yields, and it's left analysts concerned that a return to old-style Italian politics could have a knock-on effect in Europe.
Italy's credibility has greatly improved in recent months. If it engages in a new period of instability, that will make it much more difficult to solve the Eurozone crisis.
Despite Monti's efforts, the Italian economy shrank 2.3% this year, and it's expected to contract by another half a percentage point next year. Unemployment is at a record high. Many voters blame the Prime Minister's tough austerity measures for making the recession worse, something Berlusconi will play to come election time. Even if he doesn't win outright, his party could come out of the election controlling a significant chunk of Parliament.
It is not good news for Italy. It means that all the austerity measures which Monti has put through over the last year could be for nothing.
Berlusconi hasn't held back in attacking Monti's austerity policies, but the Prime Minister insists the sacrifices Italians are making now will underpin future growth and stability.
Well, as I said, Louise, we've been keeping a close eye on that 10-year bond rate this morning. I can tell you that it's up. It closed at about 4.5% on Friday, up at 4.81% so far this morning. We'll keep a close eye on that.
All right, what about European markets? How have they been reacting to the news?
Yes, well, let's take a look at those. And unsurprisingly, the Italian stock market has dropped quite considerably this Monday as well. That's down by about 2.5%. The other markets just off a little bit. Let's give you what the story was in Asia in the Monday trading session as well. There, they managed to make some gains. The Shanghai Composite up full 1% there. Nikkei holding back in Tokyo. Disappointing growth data from Japan means that the country is in a technical recession. But markets were also reacting, and will be today, to mixed news from the Chinese economy. There was a series of figures out over the weekend. Some of it was good. Industrial production, for example, was up by 10%. Retail sales also up 15%. Now, those were the best figures we've seen for 8 months. But before we get too carried away, not so good on exports. They were up just under 3%, and that was lower than expected, and just shows that any recovery that we are seeing there from the Chinese economy is fragile.
OK, back here in Europe, Greece is hoping to get approval for payment of a loan instalment.
Yes, now Greece, of course, is the other worry that we keep looking at. And Athens trying to cut its debt pile considerably. And one thing that it's done is this thing that's called a buyback. It's offering 30 to 40% of the value of bonds in an attempt to cut 20 billion euros off its debt pile. Now, it needs to get this buyback done if it's to get 34 billion euros loan instalment that it desperately needs. Now, we've heard this Monday morning, Athens has extended the deadline on the buyback from Monday until Tuesday. But on Sunday, the Greek Prime Minister, Antonis Samaras, was speaking in Germany. He said he's confident that it will be a success.
I think that developments show that we can say by Monday or Tuesday with most certainty that the program has worked.
OK, Matt, well, the UK has struggled to get out of recession, and its retail sector is still struggling.
Yes, that's right. Well, last week, the British Finance Minister announced 5 more years of austerity, and more of this belt tightening will squeeze consumers' wallets. Well, that's all taking a toll on the high street, as Jen Carswell reports.
Oxford Street, central London. Not only a shopping supercentre, but the quintessential high street, a hub of all things retail. But an hour from the capital, the story is very different. These signs of abandonment and disarray paint a worrying picture.
Anything else?
And shopkeepers have good reason to be worried.
When we moved in here, that was 6 years ago, all these shops along here were full. Business is booming, and then as you know, the recession took its toll, they all closed down one by one.
An average of 20 stores a day shuttered permanently in the first half of the year. 5 of the UK's biggest brands left the high street for good, with thousands added to the already long list of job seekers.
High street that in the past had Marks and Spencer, Boots, Next, etc. Unfortunately, that sort of high street is a thing of the past. The first thing that's really killing the high street in some ways is the internet. More and more people are using the internet as a way to find cheaper prices.
But a group of industry professionals is looking into how to revitalize these areas.
How we use our town centres is changing. So many towns are now functioning in a very different way, and we've got to adapt those towns so they're fit for the next 50 years. So it's quite a major point in our history of town centres.
The holiday shopping season is getting underway, though slowly.
With consumer spending making up 2/3 of the UK's GDP, the government is hoping that by illuminating the problem and hitting it head on, it can bring back the public before it's lights out for the high street.
Jen Carswell in London there. Well, now let's get some of the day's company news. And the biggest ever foreign investment by a Chinese firm looks likely to get the go-ahead. Oil giant CNOOC will be allowed to take over Canada's Nexen. The $15 billion deal has been approved by the country's regulators.
The Mayor of New York, Michael Bloomberg, is considering a bid for the Financial Times. That's according to reports in the New York Times. Bloomberg made his fortune with the business news empire that carries his name. Analysts value the Financial Times group at $1.2 billion.
And France's PPR Group is buying a majority stake in the Chinese jeweler Qilin. The company currently has 14 stores around the world. PPR, which owns brands including Gucci and Yves Saint Laurent, says it has great ambitions for the brand.
OK, well, that wraps up our business news for now. A big thank you to Matthew Warren. Stay tuned. Stuart Novel coming up in just a few minutes.